Hey, greetings. Welcome, traders. This is Samantha LaDuc, founder of LaDucTrading.com, joined by Craig Shapiro, our MacroAdvisor EDGE manager. So we want to kind of come to you on Fed Day and talk a little bit post FOMC meeting, pre-ECB and Bank of Japan, Thursday, Friday, respectively. Kind of play catch up on what's been going on with earnings season reaction. And basically a look ahead at these summer volumes of summer trading into August, September, and what we're looking for as a market priced for perfection. So I talked a little bit about that, but we still haven't seen a solid reversal lower, but I'm looking for it. All right, Craig, catch us up. Today's FOMC minutes, and then of course Powell's podium presentation. What are your thoughts?
Yeah, this was seemingly I don't know, the quietest Fed meeting. I think the lead into the Fed meeting was quiet, and the statement was quiet, and the press conference was quiet. It just seemed like a very anticlimactic meeting. I mean, basically going in, the odds of a hike were 90+%, so we knew that was going to get done. The statement basically didn't move at all, almost word for word. There were no changes except a modest economic improvement became a moderate economic improvement. Yeah. And so a unanimous decision to raise rates by 25 basis points. And then we get to the press conference, and the transcript, Powell's prepared remarks similarly were almost exactly the same as last month's, where he talked about commitments to bringing down inflation, so still tight labor market, and being data dependent. And so really no fireworks there. And then the questions then also seemed very kind of lackadaisical, for lack of a better word. They all the reporters tried to get him to give something about next meeting and whether or not
he wasn't biting
live or not. Yeah, the only thing he said, which I thought was a little bit interesting, although the market didn't really care too much, was I think there may have been a perception that from last meeting that the Fed was going to go every other meeting. They had gone, every meeting. And going every other meeting would be slowing the pace down. He did say that really was not the case. September is a live meeting. They could go they could hike 2 out of 3 meetings, and that would still be slowing the pace down. So they pause and then hike today and hike in September. I thought that was a little bit more hawkish maybe than the market would have thought, but it didn't really move the odds all that much for September. So where we are now really is a data dependent Fed that will get 2 inflation prints, 2 employment prints, and a host of data between now and September. We also get Jackson Hole, between now and then too. So that could.
And he does have a habit of, increasing that hawkish rhetoric for Jackson Hole. So at least
yeah. Well, look, I mean, I think it's a halfway point between the meetings, and they will, we will have the July data for Jackson Hole. So, he could signal however he wants to signal. If the rate hike odds are not high enough for September, and he feels like he needs to bump them up because core inflation reaccelerated or what have you, then he can use that as a way to do it. And similarly, if the data for July that comes out early August shows a further deceleration in core inflation, then he could tee up September as basically an off the table type of situation. So that will be important. But yeah, I think right now, the market has really come, quite a long way. We'll get into that. My overbought, oversold indicators are screaming hot, which isn't surprising. Today we saw another bout of short covering, most shorted names outperforming, short momentum baskets outperforming, high leverage stocks outperforming. So, we're getting a broadening of the strength. The question is it real buying or is it just short squeeze?
That's such a good question. Yes, exactly. That's a really, I think a little bit of both, but just a real quick comment on the FOMC price reaction that I noticed since I ran the live trading room from 2 to 3. When he came out and said this is not an environment where the FOMC should provide lots of forward guidance, market just spiked. Like they're not really announcing they're going to pause, but they're just also not going to tell you. And then when he basically said, I don't see inflation back at 2% until 2025, it did a complete 180. So on an hour bar, for example, you can see the move from 45.50 all the way up to 45.80, and then completely 180 back down. So after hours, we are getting meta reaction, which is right now spiking higher, but it does not have the staying power, and it's also a very protracted kind of outperformer. And in earnings that I've noticed, the outperformers have been getting hit after, and the underperformers, largely the value plays that were just kind of left for, what's the word, indifference, are absolutely running away on, spiking, chasing FOMO action, the 3Ms, it doesn't matter. Across the board, the value plays are definitely getting bid up after their earnings, really outsized moves. So I do think it is a combination of the short covering for sure, that hedge fund factor rotation that we've been talking about for about a month now. And then of course, just this, stalking value rotation, which triggered on June 1st. It's definitely broadening out. And folks are kind of off sides in some of these value plays. So they've been for real, like the JB Hunt had an 18% pullback in revenues, and it's still spiked and has been running since earnings. Same thing with package PKG. It's very strong misses that are getting bought. And then the overachievers are getting sold in mega cap tech land. So I think that's the theme for this earnings season so far.
Yeah, look, I mean, I think that's that makes sense. I mean, basically you have a huge universe of folks who in the multi-manager community that run low nets, that have shorts on, and the trades get crowded, and so because the themes are well known. I mean, trucking, you mentioned JB Hunt. I mean, the trucking recession kind of was front and center for a while, and so folks are short that theme. And then one good incremental data point, and then the yellow bankruptcy, and then boom, and then all it doesn't matter what the companies say, and then because once they say it, they have to, folks are set up for these earnings prints. They have to react, and it's all about positioning. And so now transports are on my indicators are in the 99th percentile of overbought. So
yeah, UMP.
Right. The question is from here, what is the what's the incremental catalyst as we transition from this micro earnings season where it's, some names up, some names down, and maybe the factors are leading us in a certain direction of short covering. From here, where do we go? What takes us there? And the macro data will drive that. And the question will be, payrolls next week, inflation print on August 10th, and the like. So because that'll determine whether or not the Fed is going to be raising again in September. And then the other thing that will be important will be this China. I don't know if it's stimulus yet. I don't know, or if it's talk or what exactly it is, but clearly there is hope about a China stimulus, and that is invigorating Chinese assets and some inflation assets. I mean, commodities are, have been firm into that, and then have sort of taken off a bit more. If I look at the Bloomberg Commodity Index, it's kind of breaking out. CRB Rind has been kind of breaking out. Oil, grains. So to the extent that commodities find their sea legs here over the next couple of weeks, we're going to be in another situation where folks have to think about inflation reacceleration, even though it's headline and in theory something the Fed doesn't care as much about. Powell did mention today that consumers are feeling better because headline inflation has fallen a lot, and that's given them more discretionary income to go see Barbie and go see Taylor Swift, both things of which I have also done. But that to the extent that we start to see gasoline going up. I saw also something that is interesting, like Verizon is going to raise wireless rates by $10 a month. I mean, for that's a lot, right? I mean, $120 a month, a year for a pickup in data like that. Everybody basically has to buy that. That has become similar to gasoline or similar to food. Everybody has everybody has broadband. Everybody needs, so more money going to those things that are less discretionary may have an impact on consumers' ability to spend elsewhere. So I think we'll start to get some fear if that starts to really starts to reaccelerate here. And with China seemingly looking like there's some momentum behind some stimulus there, although frankly, I'm still skeptical. That could be something to keep in mind too.
Yeah, they definitely have made some internal shifts in management too. New appointee for an acting governor, central bank, who's going to have a dual role. There was an article in Bloomberg on that. So, and they're definitely not independent. So there's definitely some kind of consolidation of power in China, plus article after article of proposed or actual stimulus measures, whether in property, CRE, across the board. So they are definitely picking up the rhetoric. And as such, the Chinese ADRs, the K-Web contingencies, they are absolutely percolating into kind of a base to higher move. So we definitely have some of the China plays stabilizing to higher. We have value definitely coming up off the ground and moving higher. Mega cap tech, for the most part, petering out, not spiking higher. It's still been a very strong trend in Apple and Meta, for example, but they're not having the same oomph. And that VIP, treatment of hedge funds long the mega cap tech and short the left for dead, bankruptcy risk, dash for trash, whatever the heck you want to call it. That short covering has definitely been in play. It's not quite done. I mean, if a Tupperware can spike higher 75% the next day, another 50%, even though they were issuing a bankruptcy warning back on April 7th, this whole game has clearly not been played out. So there are still pockets of massive short covering and value rotation, which is helping in my particular, intermarket analysis to help some of these durable kind of swing longs, whether it be the transports or in the EV plays of China, which have been phenomenal. And in fact, Volkswagen disclosed a 5% stake in XPEV, so that spiked higher today. But it's already been in play for the past month. So the point is, there's definitely a lot of stuff, bottom fishing plays that are working, and that is helping my intermarket assessment of better breadth, better net buying. It's not just all concentration risk. It's doing nothing for bonds. It's absolutely doing nothing in fixed income. But I find it kind of bullish. At the same time, it's totally priced for perfection. SPY is what, 20 times forward earnings, which is hot, and earnings are definitely ratcheting lower. So I'm not really seeing the impetus for drama, but I'm also not seeing any reason to move higher. So I watch the options market. I'm still very much interested in where the bulk of the aggregate options are positioned for NASDAQ and the SPY in particular. And what they have done in most recent month and a half is they have rotated into the equal weight indexes. So the EW and QQQE, they're different providers, but basically it's more equal weight because they are seeing this this broadening out. So we don't have that concentration risk as intense, but we definitely have the equal weight picking up some of the slack. So far it's working. What's your next kind of macro tell in regards to ECB and Bank of Japan, because we've got Thursday and Friday respectively with their rate decisions or yield curve, status quo decision?
Yeah, I mean, I think there's, in light of the fact that the Fed was kind of perfectly priced for today and kind of became almost like a nothing, a non-event.
It really was.
I kind of feel like that's how tomorrow and Friday will go with the ECB and BoJ. It's just if you believe in some sort of coordination amongst these central banks,
I do.
then the Fed wanted to get their hike out of the way in a way that didn't disrupt markets. I think that the ECB similarly will want to get its hike out of the way, and the ECB needs to deal certainly with the issue of a weaker economy. Right. I mean, the PMIs in Europe have been suspect. Germany economic data has been woeful lately. And so, Europe definitely has more of a growth problem than the US does. And it's also would have a larger issue if oil and, grain start to reaccelerate, because they're more of a headline inflation type ECB than necessarily the core inflation. So, but I don't think that's necessarily something that we're going to, learn much about tomorrow. And as far as the BoJ is concerned, I mean, I think it's hard, again, to speculate on if and when they're going to make some sort of move, but you'd have to, I think you'd have to assume that after, what the Fed went through today, the surprise value here, I don't really see why the BoJ is going to surprise markets with something yet. I think, but also for them, similar to last year when oil and energy prices ripped in the third quarter and into the fourth quarter, kind of forced them to, I think if we were to see that happen again with oil, that might accelerate, the move. And so last time we saw weak yen and defending the yen by selling treasuries as oil was rising, and it kind of became this self-fulfilling thing. I think this time maybe they would, choose to move on interest rates, as a way to defend against that. So, but again, I really don't see that much in the way of fireworks, for them.
IMF did come out with a little warning saying Japan, has upside risks to inflation, which we're all kind of tracking when they come out, and they are very hot. Not necessarily being passed along in the wage inflation, though. The companies are kind of keeping that themselves. And they are basically urging the Bank of Japan to tighten monetary policy, but it doesn't mean that they're going to listen. They absolutely don't have to, but it was kind of interesting timing right before the Friday release.
Right.
Anything, so we kind of like touched upon China and touched upon Japan and of course, Europe, Germany in particular. What do you kind of see for Jackson Hole? More of the same, or do you think there might be some, or is it equity related? It depends on how well we're doing, when Powell gets up there. Any surprises you're expecting for Jackson Hole?
Yeah, let me share the screen here. I think
get that date again. It's like 15th, 17th. I forget all.
Jackson Hole is I think is August 26th. It's the last Friday of August. And the lead into it is actually interesting too, because the BRICS meeting is August 23rd, 4th, and 5th. We could talk about some conspiracy theories I may have for that. But the chart I have here, I think, is still very important and telling, and something that we need to keep in mind. And this is kind of five-year inflation break-even yield. It's kind of a Fed preferred metric for whether or not inflation expectations are well anchored. And you can see that, I mean, while we've been kind of range bound, since the middle of 2021, based on this chart, it looks like this is starting to break out again, right? So to the extent that long-term inflation expectations, start to move higher, I think that's going to be something that the Fed has to contend with and deal with. I mean, if you remember a year ago, Powell, actually it was the June meeting when the Fed came out after the Michigan inflation expectations ran hot, they accelerated the rate hikes from 50 to 75 basis points. Well, here's what Michigan looks like now. Sorry, this is so basically on the median, we're exactly where we were back in June with a 3% handle. I know this is like not as many people, but like if you look at the mean, so this is the mean expectation in UMich, like we've blown through the highs here. We're making massive new highs here in inflation. And so inflation expectations 5 to 10 years out. And, we're talking about 400 to 600 people being surveyed in Michigan. So I don't want to, put an extraordinary amount of weight on this, but to the extent that this keeps moving, right, you're going to trend. Yeah, you're going to bring back folks, thinking about inflation again, just at the point in time, and I wrote this earlier today, where I think markets are pricing in to perfection this immaculate disinflation story, right? I mean, this is oil. I mean, like this is starting to look better to me. This is the CRB rind, which is raw commodities. Prices, and I'm a little bit slow here. I mean, again, a I mean, this looks like it's nicely bounced off the lows and moving higher again. This is a Bloomberg commodity index, right? Like, so, again, bounced off the lows here, and it's going to, as the year progresses, the comps are going to start getting easier as this moves higher and last year moved lower, right? You're going to start to see that pickup in headline inflation again. And so what is the Fed going to do in an environment where headline inflation reaccelerates again? I mean, they're certainly going to be raising another time this year and likely maybe 2 times. I mean, also you're going to get a pickup in inflation volatility. I suspect that what's going to wind up happening here is we're going to start to see yields move higher. And I'm curious to hear what your thoughts on the charts here, but I don't know. I feel for me, like I want to be short bonds here. And I put out some, some TLT puts after the Fed meeting today. And I just think yields are moving higher. I think that the inflation story is not finished. I think wealth effect is still reasonable. And I see the potential for yields to be moving, higher here. And the kind of conspiratorial view into this BRICS meeting is that, BRICS are getting ready and getting set up for this kind of change in the currency regime. And while they're not going to be replacing dollar per se in every transaction, there's going to be an increased desire of BRICS countries to transact away from dollars and to store reserves away from US treasuries. And so to the extent that we have demand for treasuries from foreigners coming down because BRICS are settling in RMB or settling in gold or what have you, I think there's risk to seeing these yields moving higher, particularly as deficits are growing and the supply calendar for the treasury, we'll find out in detail next week. That's actually a very important catalyst is next Wednesday. Will be the details behind treasuries duration selling that's going to happen for the next 3 months. And to the extent that we see, I think there's expectations for about 200 to 250 billion of duration selling for the next 3 months, which would be up quarter on quarter, but nothing out of the realm of reality. To the extent that that's a much higher number, 300 billion plus, 350 billion, 400 billion, a signal from Treasury like, okay, we're going to hit these bids here on low yields. If that were to happen, I think that would lead to a bond market that starts to get spooked a bit. So next Wednesday is when it will be on top of that. Oh, interesting. All right. So then what, just as a complete left field tweet that came out just as Powell was about to take center stage was a mention of McConnell and GOP and debt ceiling. Do you know anything in substance about that? Because I thought that we had already dealt with that for this fiscal year. Do you know what I'm referring to? It was a very sudden. I don't. I know McConnell had there was some sort of health scare. But it was more than that. It was actually, I'm trying to go find the tweet exactly. No, specifically, U.S. Senate Majority Leader Schumer. I am worried House GOP are heading to government shutdown. Literally 2 hours ago, exactly the same minute Powell was stepping in front of the cameras. Yeah. So what is this about? Like, I thought we dealt with that. Yeah, I mean, I think what we did was we dealt with the debt ceiling, and what they did was table a lot of these the spending conversations to appropriations committee meetings that were supposed to be giving budgets for this year, and the budgets need to be kind of locked in by September 30th. And so that's for fiscal year end. And so to the extent that that doesn't happen, we could do continuing resolutions, but at some point, depending on how Republicans vote and how this goes down, they could decide to basically shut the government down. If the Republicans can decide to shut the government down if we don't get to some agreement. So I haven't heard too much that was a risk, but look, as we get into that period of time, August, September, October, there's various reasons historically why markets get a little bit dicey around that period of time, and government shutdown, factors into that. I think that would be, again, a growth hiccup. A growth hiccup. That's a good way of putting it. But it's hard to bet on that now, but we'll keep an eye on it and see if that starts to generate any momentum over the coming weeks.
Okay. And the outcome for UPS and, Teamsters and all of that is basically that wage inflation is alive and well. So when you're talking about your bond short, I mean, I'm a big bond bear and I don't see wage inflation reversing. So to me, this is just picking up speed into, more risk of hikes next year. So, into a credit.
I just think that there's been this incessant bid for duration, and it's shocking to me, frankly.
Because I think recession is no longer a worry, right? I mean, but this is a long story, and inflation can have waves. So
look, I mean, I think lending the U.S. government money for 30 years at sub 4%, when inflation, what the chart I just showed you for 5 to 10 year inflation is running 4.5%. I mean, it just seems ludicrous to me. And so if you believe, like the bond market believes, that the Fed is going to slay inflation and it's going to lead to some sort of growth slowdown that brings inflation down, that makes you want to buy bonds, then I think equities are woefully mispriced because if we're going to have a recession, earnings are going to get hit, labor market's going to get hit, and multiples are going to come down. So I would want to sell equities in that environment if the bond market's right. On the flip side, if we have inflation reacceleration here, and we don't have that recession, bonds are completely mispriced. So that's why I was kind of getting to this peak immaculate disinflation pricing philosophy, or where we are right now. When I see a market that is basically perfectly priced in the Fed soft landing, achieving this immaculate disinflation. That's why S&Ps in this 99th percentile of overbought. That's why the most short index is overbought. That's why vol is fairly oversold. And I think about where we are, in the timing, this is the, vol seasonally puts a low in the second half of July. We got the August, September, October period. We have this BRICS meeting, we have Jackson Hole, we have all this data. This is the window when markets, struggle. And that to me just, has me, has a top down, worry on. And are there certain names that are going to work? Look, if oil keeps going up, energy stocks they're going to do better. They're going to work, and maybe
inflation trades in general do better. There's no question about that.
Yeah,
so
maybe we'll have
yields.
Maybe we'll have a graceful rotation from growth to value. I don't know, but
graceful.
I think so.
The past 2 months, we've already had kind of the start of the growth to value rotation, especially since June 1st. I mean, there's industrials. I mean, you name it. They have definitely come up off the ground and helped broaden out the rally, while FPX really did not spike higher aggressively in the past month. So it's supportive. But to mention your kind of VIX comment that we're on the lows and seasonally. So the SPX 1 month realized volatility is 8.88. That's cheap. And Bank of America quants came in and basically said, this is the cheapest it has been in years for 1 year look forward in SPY puts. So people aren't buying the puts. They're still, happy the market's moving higher and it's broadened out. And the Fed seemingly has, quote unquote, inflation under control. But yeah, we don't really need too much for a trigger to go into negative gamma. We've been in a beautiful backdrop of positive gamma the whole way up since March. It's been just, except for a little pause there in April to catch our breath. AI has absolutely not had the same oomph. Microsoft even said it's a tomorrow opportunity, but for right now, they're not banking on it. So I think it's really just we're priced to perfection. We've built in everything: the bank bailouts, the AI, the higher multiples, the rotation, the short covering soon. Right. And always, this has happened not once but twice, but 3 times I've tracked this hedge fund factor rotation. And literally from 2018, 2020, and now 2023 summer. And the last one happened to be June, July of 2020. So it's fascinating. It literally has been 3 years. Anyway, the fact is, I think that once this peters out with the hedge fund short covering, we absolutely have a nice backdrop for a pullback. How strong? Not sure yet. We got a first rollover.
Right. Look, I think when I say price of perfection, it's not just that the S&P at 4,600 and it's the internals, right? It's the it's the short covering that's ripped. It's also cross asset, right? It's also where the yield curve is now, the 100 basis point, inversion, right? We've priced in a lot of this perfect scenario where the Fed has got it perfectly figured out. And so from here, as the data comes in, that will determine where we go next. If we start to see slow data, inflation falling, deflation fears, crude rolls over, growth hiccups, because let's say the employment number comes out next week and it's horrific. Like, are we going to rally? Are we going to rally massively on that? No, I think we'd sell off on that, because it'd be, oh crap, growth is actually finally getting hit, and the Fed's not doing anything about it. And frankly, they've kind of articulated no cuts for at least a year. So that's
May, yeah,
that's a concern. So I think that would be, on the flip side, if we got a very, very robust payroll print next week, I think bonds would get killed, because there'd be this in this belief then that the Fed will need to do more. Inflation is not going to be under control, and this is a problem. So that's why I think we're at that point where as the data comes in, markets are going to react, violently to that data, because we've sucked in everybody, we've taken out all the shorts, and we're at a place where it is kind of uncertain, the direction of the economy. Every data points I see would suggest that the economy is going to roll over at some point. Maybe has already started, right? You saw the services PMI earlier this week, it's not that good. Saw a decent deceleration. But then you get data points that are still good. So I think it's
the wage inflation, my mantra that this has really saved us or delayed recession.
We get ECI on Friday, which will be important. That's the employment cost index. Powell referenced it today as a question. Market's looking for a 1.1% gain in the second quarter. That's down from 1.2% in the first quarter. That's a big number. I mean, if we get 1.3, 1.4, 1.5, folks will say, oh crap, okay, services inflation is coming. It's going to be stickier. It's going to be a problem. Fed's going to have to do more. On the flip side, that number comes down, people will feel good about this immaculate disinflation story. And then PCE is also on Fridays. Both come in at 8:30. So that is an important, and Michigan, we'll get another Michigan reading on Friday too. So stay tuned for that.
All right. So I have a chart for you that needs your comments here. This is credit. So let me just move this out of the way, since that's in the way. There you go. You can see total bank credit year over year.
Yeah.
Since they started hiking, it has contracted, and obviously the market, the economy still has lots of money, and wages have absolutely inflated, increasing, nominal wages as well, which translates to demand and spending, which has obviously helped delay recession. But big picture, we got no total bank credit expansion. So when does that matter?
Yeah, I think what you have this really bifurcated market where, the S&P 500 companies generally do well, are like I say, impervious to bank credit, but they don't need the money, right? There's plenty of money in the S&P now under, for the next 1,500 to 2,000 companies, and certainly for the 50,000 companies that are small businesses that need credit. This is a problem, right? Not being able to get credit is a problem, but there's this dichotomy between what you see in the stock market, because those are the strongest, biggest companies in the world who don't really need bank credit growth to fund their businesses, to this to the rest of the economy, which doesn't show up in the S&P 500. So I think you're starting to see it in the rest of the economy. You just don't see it in the S&P 500. And as far as maybe the Russell 2000 or Russell 3000, that's where you'd see it first. And look, the Russell certainly has been stronger than I would have thought. I think that has a lot to do with this broadening out of the rally, this short covering, this rotation trade. But let's see, this is where I think the rubber hits the road as rates are moving higher, credit is contracting, the economy is likely to slow, small caps are going to feel it. first. And, I would be more inclined to be short small caps than long them, over the course of the next
I
3
still don't
months.
see a turn in NYSE. So NYSE for me is the one that I kind of do all my intermarket action on, and then I drill down to the sectors, and I am not seeing yet that roll over. I know you've got it as their 98th percentile, but you also have that for the Qs. And to me, one is less sure for me that growth to value rotation will help support the NYSE world versus the mega cap tech, into the second half. I'm seeing that is starting to roll over, and it's really like the Titanic that has to turn. It takes a while, but I don't see it hitting an iceberg. I just see it needing to turn. So for me, that growth to value rotation is absolutely has started June 1st, broadening this out. I'm not separate from the hedge fund short covering. I'm just talking about it has broadened out, and I see this turning and will be very durable for the second half. The question I really have is, what does that mean for the indices, and when do we actually get, again, not the iceberg, which everyone always focuses on, maybe the debt ceiling, which I hadn't even been on my radar. And who knows when Bank of Japan will do its yield curve widening, widening. But the point is, for me, it's just a turn. So I think it's tougher to short the small caps in that scenario. And the reflation trades also get supported with what you've already laid out in regards to, oil and
Look,
I
think part of what my thesis is, and needs to be constantly checked on, but is that when liquidity is being drained, I'm throwing the chart up here, my net liquidity indicator, everybody's seen it from me and from 50 other people. When liquidity is being drained, I find that the rotations don't stick. And I feel like it's basically you have these alpha unwinds, growth to value. And then once that covering has been done, we get the face plant, right? We get to move lower. And so, but when liquidity is being added, like here back in March, or even here in May, then those rotations work. So basically what we've had so far, liquidity has been drained, not an enormous amount, but it has started to come in since the debt ceiling was passed. And so you mentioned this growth to value rotation, which we started to see amidst a $200+ billion US liquidity drain. From here, now that we've covered everything, for lack of a better word, and my indication of that we've covered everything is that these indices are screening very, very overbought. So the question is, if we get another 200 billion or so of liquidity drain, I think that's going to be assets down again. So what are we likely to get? I mean, we're going to get next week, we're going to get the Treasury's expectation for quarter end cash on the balance sheet. So right here, let's see, where are we now? Treasury is at 575 billion. Yellen said on the last TBAC meeting that she expected to be at 600 billion. That doesn't mean that she can't be more. So we'll see. If she comes out and says we'll be 700 billion, then she'll be 700 billion, right? And then on the flip side, not on the flip side, but also what we have next week is we have this duration concept. And so what we just got today is the RRP, now has moved up to 5.4%, or I'm sorry, 5.3%. So we've seen a fairly good draining of the RRP, which as kind of in line with the base of the money has gone from RRP into the TGA for a decent, chunk of that 60 or 70% of the move. But from here, now the RRP is 5.3%. As there's more uncertainty, are we going to get a resurgence in flows back into the RRP here? We'll have to keep an eye on that. That will be a liquidity drain. So I think you're going to wind up having liquidity drain further. Plus you have QT, every month, 90 billion, 95 billion happens like clockwork. So, and it's always back end loaded. So for the month, so we're about to get, it won't show up in this week's data, it'll show up in next week's data for July 30th. So that, basically you're going to have this is bank federal asset Fed reserves, Fed assets, right? They're coming down. I mean, it's not, it's hard, so now we're below where we were pre-SVB. And so the question then becomes, does it come out of bank reserves or not? And it's, we'll keep an eye. This is the SVB. We were here, so we got to keep an eye on bank reserves. But I think liquidity continues to get drained. It's going to get drained in Europe as well. I don't think China is really adding a material amount of liquidity yet. And so any of these global liquidity indicators are going to show more liquidity drain. And if that's the case, I think the growth to value rotation doesn't have more legs than kind of what we've already seen.
So where does money flow?
Yeah, I think money's going to flow back into the safest assets again, which is
really,
very, very front loaded treasuries. I think you're gonna see money flow into the shortest duration type stuff. And if you can still earn, now you can earn 5.3% by giving it to the Fed every night. I think that's where the money's going to flow back into. And look, I think there's going to be money that does go into some of this treasury issuance. I just think it's going to be at higher and higher yields. So Treasury is going to sell 300 billion of duration securities in the next 3 months. That will be a place where money goes, but it won't be done at 30s at 4%. It might be 4.2% or 4.4%. So money can flow into fixed income and prices still, can fall and yields can rise. So I kind of see how that's how it moves. And I think as far as commodities are concerned, I think we will continue to get flow into commodities. I suspect oil will continue to see some flow. I think gold still is interesting, particularly into this BRICS meeting, end of next month. So I think commodities will get some flows as well.
Yeah, so that's part of the value rotation. All right, so let me kind of open this up to any questions, please, because I know this is what you're talking about, Craig, is very much the fixed income arena and yield harvesting, at its finest, and anticipating equity money flow as it impacts, equity returns. I'm a little bit, very focused on equities and very much options, the structure of therein. So when you're talking about the liquidity flows, I'm all over that, but I want to see how this is going to put a bid under a 10-year in particular, because every time it gets to an inflection point, it has the plunge protection team spring into action. So whether that was in September, October of 2022, or just the March risk of bank backstopping, and then just recently, literally, the dollar yen getting a little bit too elevated, and it came in and walloped the dollar, 3 sigma move with yields. So they've started to climb back up, but they're hardly momentum driven. And I would say the same thing about oil. I follow crude very closely, and I think we're just in a massive chop area between basically, 65 and 83. We overshoot a little bit to the downside. We got that 62 print that we came right back up. I should say 78 and 65 with an overshoot to 83 and 62. But to me, that's a tradable range, but it's not investment. It's not oil as an inflation hedge again. So we would need to get and stay above 85. I just don't see the interest there. They won't let it. Even though we do have the SPR, they're done selling and they need to start buying again. That's going to be an issue for October. We also have the seasonally strong nat gas in that period of time as well. So, I mean, definitely we have the risks there, and positioning. I'm not seeing it so much yet. So, when I see it, I'm going to know it, but I don't see it so much yet. Right now, I just think this is still the 10-year. It gets up there and it's whack-a-mole, government intervention at its finest. Same thing with oil. Same thing with the dollar. So it's when they lose control, that's when the alarm bells will start ringing, and it will be my utterance of bond bulls better defend here or else. And we're getting close. We keep getting closer and closer, but we really haven't had a catalyst or a trigger. So you think there might be something in the dark there with the RRP specifically, or is there another kind of unknown that you're tracking to figure out when we're going to have this repo madness part 2?
Yeah, it's really, look, we've been in this kind of this perpetual cycle for last little bit where the Fed is raising rates, but the economy continues to kind of chug along nicely. And what winds up happening is long-term interest rates, keep being supported by this duration bid. It's almost like this reflexive issue where the yield curve continues to invert. Money goes into by the back end, which then lowers interest rates, which then allows corporates to borrow and multiples to expand and the stock market to go up. And it's like we haven't had the tightening from the Fed really tightened financial conditions enough to get inflation under control. So yes,
and
inflation.
Way too much money. How can they?
It's just too much money in the system. In order to get to the next phase, I think we need to see a catalyst that breaks the back of the duration buyers. And so the question is, what is going to, get yields? I think sorry. Can you hear me okay?
I can see you. I can hear you. No, I was going to say, I've got an answer.
Okay. Well, so it's basically something that shakes the confidence of the duration buyer. And so that you could shake the confidence of the duration buyer if you saw a reacceleration of inflation, which is possible now, given what oil is doing, grains are doing, commodities are doing, which we've shown. And the other thing, which I think you could shake the confidence of the duration buyer, would be if we get a shitload of selling by the Treasury or somebody else. And so what we're going to get next week is we are going to get a data point that comes out 4 times a year. So it is important. The TBAC, the Treasury Borrowing Advisor Committee, gives the forecast for the next 3 months of Treasury selling. To the extent that the Treasury decides that it's going to shift from the bill selling that it's been doing for the last several months to more of a duration selling backdrop, because bills now are getting towards the high end of where historically Treasury has wanted them to be as a percentage of the total amount outstanding. We're getting up towards 20%. So there is a theoretical cap on how much bills should be as a percentage of the total borrowing. That means we're going to shift towards duration selling. And if the duration selling headline we get next Wednesday is that Treasury is going to sell, 100 billion more than people thought, or 200 billion more, that's something that could shake the confidence of the duration buyer and say, oh shit, there's going to be a lot of selling coming from Treasury. Similarly, there are a lot of foreign holders of Treasuries that could be thinking about selling. Why would they be thinking about selling? Well, our allies, Japan and Europe, that own Treasuries could be forced to sell like they were last in the third quarter if energy prices start to go in order to defend their currencies. Maybe they look to start selling some Treasuries, but really the bigger driver probably is China. And so to the extent that China accelerates their selling of Treasuries, why would they do that? Because they're looking to protect their local economy, stimulate, and maybe transition away from using Treasuries as a reserve asset into this BRICS meeting. You may have China selling at the same time that you have Treasury picking up their selling, and that could be your frying pan moment, for lack of it, that kind of shakes the confidence of the duration bull. And then once yields start moving higher, then I think we've kind of hit this next phase of and reason to be more concerned about risk. So that's something to look forward to potentially next week. We'll know Wednesday kind of how serious Treasury is about selling duration. And I think that could act as a catalyst for the eventual move, because once interest rates at the long end start moving higher, it really starts to change everything as far as multiples are concerned. It starts to change kind of where inflation expectations might move to. And so I think that is something that we could get imminently that could change the psyche of this risk markets, which have just, again, have been this reflexive positive feed loop of better data, but still duration buying, lowers cost of capital, raises multiples, and we just kind of keep going because we don't really flip the script on Treasury supply. We're getting close to that point. We'll know next week if we actually got it. And look, if Yellen punts again and issues less than expected supply, we'll make a new high, right? We'll make new highs in stocks. We may have a blow off top, but I think at that point, gold will go, oil will go, inflation expectations will go, and then the Fed will really have to come in later and fix that mess.
All right, we got a few questions. Let's kind of go through this. One is in regards to this TLT positioning. Let me just comment. I haven't looked at this. So you're saying that there is a large, I don't know if buying, selling, what it was, 125, 130, 135 strikes for October, November 2023. October, November. I don't see that. Hold on. I see 125. Hold on, let me just show you. That is December. That's December. They're all, yeah, they're all end of year. You have to show me that one. Here, let me show you what I see in regards to TLT, and then hold on, share the screen. Where the heck is it?
It's also worth keeping in mind that like TLT, I don't think is the best
representation
of kind of how folks participate in the bond market. I mean, it's TLT in this size is being used by equity funds that are trying to hedge either their books or interest rate risk, and the only way they could do it is by trading TLT as opposed to trading futures or what have you. So
yeah,
I just think like I don't know, TLT that I think is it's kind of a weird screwed up ETF for that reason, but not that it's not important. But if you want to make a big bet on bonds for the end of the year that we're gonna have a huge rally in bonds, then just go out and buy bond futures. Like, why do you need to mess around with TLT?
So that's why I wanted to kind of go over technically and then comment on that open interest, because I haven't looked at it before for TLT. This is the 40-year bond bull, that basically broke down definitively. This is T-bond futures ZB1, but just this kind of, you can kind of really see clearly. And then we had this, bounce into resistance. August 2020 just gave up the ghost. It was really October, November, December with the higher oil as well. But inflation stayed very bid until we got into this September, October central bank liquidity infusion. So this is ZB T-bond futures. You can kind of see this is on a weekly, that's on a daily. I show this for clients every single day. So this support didn't hold and it's rolled over. We had the one and done kind of V-shape, looked very productive for higher, not just the ZB, ZN, whatever, TLT, but then it rolled over very quickly. So it doesn't have a lot of energy here, but it is, I agree with you, seasonally a strong period. Like VIX usually puts in its low in July, bonds typically perform better in the second half. So I'm going to assume when I go to TLT, just as an example, like right now, TLT, this is open interest by strike, all options, strikes, and all expiries, just to kind of show, like if I kind of zoom in here, I can see the concentration is August, right? This is where we are right now. We got some 105s. This does not tell me the direction, okay, puts or calls in aggregate is what it shows, and the largest concentration. Now, if I zoom out, I can see your 125, this 125, 130, 133, 138 even of concentration in December. So that's what I think you're referring to in your question of they're expecting a big move. It's kind of a butterfly, basically. That's way swinging for the fences. That's way higher than I would give it any credence to get there. So that would be expecting, I mean, if you're bullish, obviously TLT into these numbers, you're expecting a big crash in the 10-year. So I think that I don't think they're, I can't tell what the heck that is. Honestly, this to me is a little bit whacked as it relates to large positioning end of year in this figure would indicate a very sharp pull down in yields. That's not what I think Craig and I see. We still see strength and big picture. Let me just kind of show you on that strength. unless I'm reading that kind of butterfly of December incorrectly. Here's strength. Yields are strong. So here is just an example of the 10-year on a monthly, big picture. This is not option positioning. This is just the actual 10-year. We had a massive move like none other off the COVID lows, right? It never, ever has it been this high. This is like Civil War high. So it's been very big strength in the 10-year. And here we are, right? This was taken, back at the end of June. But the point is we're still here, right? We're still chopping about this 3.8 area. So measured move, if this turns out to be this inverse head and shoulders, technically speaking, is way up here at about 6.5% in time. It's very much a strong, higher yield technical call. But again, I don't know what the TLT folks are doing. ZB to me looks weak sauce. Other question, let's see. Oh yeah, Leslie's also saying because pension plans, et cetera, can't buy bond futures. So she does have a point there. All right, so the other question, your view of what is the importance of credit to indexes and commodities like oil and gas? Craig, do you want to answer that?
Look, credit spreads have been super tight. Again, we're kind of getting closer to record tight in certain areas. And look, I think that's a function of the amount of liquidity that remains in the system. And so, folks are continuing to be attracted to yields which are higher. But look, I think as interest rates rise and corporate borrowers are more into strain and stress, credit spreads are going to widen out. As it pertains particularly to oil, I mean, there used to be, an issue with how oil companies and small cap oil companies were a outsized part of high yield indices on credit. It's no longer, as big of a deal as it was before. So I think there's a question here about how it pertains to indexes, but yeah, look, I think slower economy, tightening financial conditions, higher rates, it should be credit widening. Hasn't accelerated yet, but if we get into a recessionary scenario where the rates really start to bite, credit spreads will widen, and that will be an indication of, I think, will be a headwind for risk assets, particularly smaller cap equities, which I think would fit more in the high yield camp than some of the larger cap S&P type names.
All right. And this question in regards to nat gas, I don't think this is happening until we get into September, October. And I keep showing this particular chart as well, which is kind of an exercise in frustration, but we'll get there. Let me just show you real quick.
I mean, we're always one weather event away from getting a bid.
Yeah, this is true. We got hurricane season.
Yeah, I mean, but
extra cooling.
Yeah.
But
so
as it relates to seasonality, it really is a September kind of thing. Okay, so first of all, let me just go to nat gas, the underlying. Here we are, right? Massive European drama. And this is completely unwound. We can talk about the reasons why, but the point is nat gas has been snaking around, and I show this chart every day too. And we really have not been able to get outside of this massive, February last year, February, March of this year, all the way through to August, we have just been on the ground. So this really has got to kick out and stay above some key levels, and then we could absolutely double, no question, but we have to get above it. It's a massive base. The longer the base, the higher in space. It could double. This is all part of the kind of inflationary fuel for sure, especially in Europe, but we're not there yet. I don't know if that answers your question, but seasonally, it's much stronger in September. Oil, same thing. Like, look at this massive, right? This is the 130, the crude high. Then we failed this lovely trend line. So technically speaking, we kind of came down into some support areas, but I have a monthly chart that I much prefer that shows if we break this area down here in the 65s, we're going to go to 55. So far, we keep getting defended, and that's fine and dandy. Market, again, doesn't want it too hot or too cold. We've got the Goldilocks, remember. This was an OPEC cut. It was absolutely short the rip. We had another OPEX cut right here. It was short the rip. Anyway, the point is this has been moving a little bit higher. And we're just still, in my consideration anyway, in the chop zone. I'm not even interested in this as a durable trend until we can get and stay above 85. So for me, this is still kind of reflationary impulse, but we have no open interest in this product, no speculators coming in and really laying down lots and lots of energy, meaning money, to bid this up and position for this moving higher. Not yet. So the nat gas and oil are still tradable, but not investable yet. Question, liquidity decreasing and stock indices rising, something doesn't make sense. Is money from bonds flowing into stocks? That's a good question, because I think for the most part, liquidity came in October massively, and we really have just had, poor risk return on anything bond related, especially with, risk of recession, which we didn't get because wage inflation has been so strong to increase that kind of nominal buying power, spending, what have you. But and dollar has not been a headwind either. Anyway, I don't see bonds as a good risk reward. So, and your explanation is much more elegant, but I just don't see it as a good risk reward. They can park it in a 3-month yield and get 5.5%. So anyway, your answer to that question in regards where's money flowing, again, it changes, by the way. It went into paid to wait mode for a while back in September, October, right up into the bank bailout backstop of March. And then money started coming in off the sidelines, and concentration risk, was intense with mega cap tech, so much so that they couldn't buy anymore. So now funds are like distributing that into the oversold value plays, and you can see that in earnings. Oh my goodness, even if the earnings aren't that great, they're still getting bought because they're cheap relative to the concentration risk of mega cap tech. So for me, I don't think bonds are just good risk reward, but equities have broadened out. There's money rotating there for sure.
Yeah, there's a comment question in here about 1987 and the Dow being up 13 days in a row. When do I see it coming to an end? So it's just interesting that this 1987 kind of lurks in the background of every trader's mind, just what could happen over a very quick period of time. And certainly I think Darius Dale wrote about this today, about maybe that's where you're getting this call from, about 13 days in a row, or maybe somewhere else, but that the market is up that much 13 days in a row in 1987. We also have kind of sentiment indicators now are extremely elevated, similar to what we saw in 1987, and we also have this idea of the zero data expiry phenomenon is in some ways analogous to portfolio insurance back in 87. You have this kind of options related situation that could exacerbate selling if and when it does happen. And so the question is, how does today look versus 87? And what I think is interesting is what you had in the run up to 87 was you had a very significant move in yields higher in the long end and a steepening. And the reason that you had yields higher, in the back end, was you had a reacceleration of inflation that started in July and August and September of 87 that kind of kicked off this the next leg of a bond bear market. And you also had some geopolitical strain that saw oil prices move, significantly higher. Obviously, order of magnitude, the prices were lower back then, but on a percentage basis, things moved. So to the extent that we had something now that dislodges the bond market, that brings long end yields materially higher sooner rather than later, I think that is something that will cause consternation and stress in a very rapid period of time. And so what could cause that? We went through it before on the demand side. If inflation reaccelerates, people are going to start to price in higher term premiums, inflation volatility, and yields in the back end are going to move higher. And then what I think more importantly on the supply side, you have this concept of Treasury needing to accelerate their selling of duration, particularly as deficits are growing and growing more rapidly. And you may have you have the Fed, which is selling, which is not reinvesting, so effectively is selling. Although it would be nicer if the Fed decided to sell more of their treasuries rather than just not let things roll off. That certainly would I think kick off a scare in the bond market. I don't really see that happening. But you have foreign holders of treasuries, particularly China, who may look to accelerate their selling, particularly if they believe in this new BRICS concept currency. And again, I don't think BRICS is going to come out at the end of August and announce some sort of new BRICS currency. That I don't see that as the outcome. What I see as the outcome is a growing percentage of global trade and is going to be done away from USD, and an increasing amount of reserves are going to be held away from US treasuries, because as we've seen, you could have your treasuries expropriated if you kind of go against the US government, or you decide to attack your neighbor, or some pretty horrible things. But it does happen when the US finds a reason to kind of block your access to your money. So I think more and more countries are gonna be shifting away from using treasuries as a reserve asset. So you're gonna reduce the amount of demand for those assets. That's the type of environment that we could kind of walk into, where the 30 year, which I mentioned earlier, doesn't start with a 3 handle, it starts with a 6 handle, which is where I think it should probably be. And so that's the
4.5 at least. Yeah.
Look, I mean, I think the path is, enough should be, something that scares people. But those are the types of things that I think could lead us down to this 87 type scenario. Again, calling for it means it's never going to happen, but there certainly is a pathway to see why it would happen. And it's this kind of rip the Band-Aid off approach, where bond investors realize that that buying duration to the US government that is increasing deficits, that where foreigners are selling, and that they finally wake up and realize this is a bad idea. And it's that kind of frying pan moment where we go from 4% on 30 year to 5% in a month. And all of a sudden, everyone has to change their DCF model, their equity valuations, their multiples. And that leads you to this kind of follow-on 87 type, significant market correction, which, is possible in light of the options and the microstructure and the zero data expiry and all the other, good stuff, which, we do follow. So.
But we're not there yet. I want to show a chart on the gold in response to the gold question. Medium term, long term can be bond bearish. Yeah. Okay, so yes, in answer to the last one, in the pain trade in the medium term, long bond bullish, but in the longer term, bond bearish. In order for that to happen, I need the 10 year to get and stay below 3.678, and then I need for it to break below 3.33 and stay there. So the only way that I am bullish bonds is if the 10 year can break those levels and stick that landing. Otherwise, we have just been really sideways and percolating higher, and then getting that, intervention, percolating higher, getting that intervention, percolating higher, getting that intervention. So this is basically diminishing law of return of diminishing returns with trying to go long bonds when we keep having strong 10-year spikes. That's what I keep seeing. And technically, it is extremely strong on a monthly. So until I can see a solid rollover, and right now commodities are bid, yields are still staying firm, and bonds are going nowhere fast. So there just isn't, this. I know it is seasonally strong at the second half of the year. I get that. So is VIX, low in July, but it doesn't mean we're going to go there right away. And I still need to see evidence of it. But in regards to gold, let me just kind of put this up, because I think, is it a bond? No, that was the wrong question. Is it a bull trap? Let me just show you something here, and I got to move this out of the way. I like to show this for clients because it's been very, very helpful. It's bullish percent index for gold miners, and I hope you could even see it. But basically, we had this phenomenal move. Again, hopefully you can see this. Let me just talk you through it. This is October, September, when gold was extremely oversold. Craig was the first one to go long gold. And I'm like, wait, I need confirmation. Anyway, he wasn't waiting. He went and he was absolutely first and he was absolutely right. Okay, so this indicator started moving higher. Again, this is kind of loose monetary policy. Gold likes that. By the way, so does NASDAQ. This is the central bank coordinated global liquidity infusion. And basically it really, really worked well for gold. It did have a nice pullback and then it shot up higher. Guess what? March bank bailout. Okay, since then it has been petering out and falling, but not very, very hard. Anyway, this indicator that I love to use, and I know it's probably a little hard to see, so let me see if I can make this a little bit bigger. Right here, yes, has basically bounced beautifully, has bounced beautifully as the dollar yen has rolled over of late. By the way, this is on a weekly, so we're talking, a bigger time frame. For example, this is August of 2020 when both bonds and gold petered out. Anyway, the point is, this was extremely overbought. This is extremely oversold. This indicator of intermarket analysis really, really worked. It also had the macro as its backdrop. Right now, we're going nowhere fast. We've rolled over, and then even relative to SPY, hopefully you can see this, we have absolutely petered out. I was really hoping that this would continue to at least hold it, hold its power, so the gold bulls would be rewarded. But nope, there is a bunch of gaps below on gold, silver, and miners. Silver's been the strongest performer, but because it's both industrial. But for me, gold is definitely not safe until it can prove to have staying power above this indicator. And so far, I think, in answer to your question, it is a bull trap, and it needs time to base and then move steadily higher, and we're just not there yet. So it's been a little frustrating, but it has been absolutely working with the dollar yen. For anyone who kind of covers my fascination with the dollar yen and gold, they have been just really nicely. Let me find out where you just went and put that back up again. And then I just realized we're like way over time. All right, so let's do this. So here's a chart for you to kind of keep on your radar, because it works just so extremely well. Hold on, share my screen and get right here. Do this again. I moved stuff. Here's the dollar yen, right? This is beautiful. This, by the way, is an October 152 high. Again, tons and tons of central bank liquidity infusion. And then here we are, dollar yen hit that 145, rolled over precipitously, not a little bit, but a lot. And the dollar also fell very strongly with it. It has since, kind of bounced, oversold, bounce with the dollar, about 50% of that move. And gold has just been digesting sideways. So it has really, really not a chance unless the dollar yen starts to roll over very, very strongly and starts to break down below this 138, then I think gold can start moving higher again. But they do run oftentimes kind of inverse, if that helps. So any other last questions? Because I just remember we're way over that time frame, but I wanted to get through questions and talk macro to micro, since we haven't had a chance to do this in, I think, a month, and then we probably won't do it again for another month. I did answer at least my opinion of there is no deflation with a very long tweet storm. And I put that in chat. It's also in my Twitter thread. I put 15 charts of why I'm still an inflationista. So to be inflationista means I'm also bullish yields, right? So that makes me a bond bear by definition, in a nutshell. It does not make me a gold bull yet. So there's that, but it's very tradable. And right now it's going sideways with, honestly, bonds. There just isn't a lot of energy in that space. Did we hit everybody? I think we did. And I'm going to, again, thank you, Craig, for doing this with me so we can kind of get a lay of the land and get also a sense of questions by folks. They can see and hear how we kind of approach this. But I love your kind of definitions in regards to liquidity and fixed income markets and its impact on equities. There is always a worry of 1987, but we don't really know the trigger until it's right here in front of us. And I think your tick data is one to watch. So are jobless claims, unemployment rate. I have a big thesis about that, but we're not there yet. We have not ticked above my line in the sand. And obviously yields need to get and stay above this 4 level for there to really be a headwind. Dollar is not the headwind right now. It's actually, you know, kind of suffering on lots of different fronts, the Druckenmiller playbook. But for right now, we'll revisit what happens post, not right before Jackson Hole in mid-August. And thank you everyone for attending. Any final comments, Craig, before we close?
No, look, I think you know, Friday is data to next Wednesday. Plus we have, I guess, Apple sometime next week. So that, you know, those are big drivers, and you know, we're into that weakness period, August through September, through October. So
Don't be complacent.
Yeah, and look, I mean, folks have had a great, you know, start to the year. Big gains across a lot of things. You know, just be mindful of that and take profits when things don't run trailing stops. Take profits when things aren't working, and you know, be mindful that, you know, there's still macro risk out there, which could lead to significant you know, corrections, because
Repricing.
with markets not cheap and things can move fast. So you have to kind of keep insuring your portfolio against those adverse outcomes, particularly when there are data points that are known in advance. Like today was a data point, right? The Fed meeting is a data point. Next Friday payrolls, you know, those are times when markets can move. So you need to be mindful of those. You know, not every day is a macro day, but you know, on the days where we do have the kind of macro days, you know, portfolios can move violently both directions and quickly. So those are the days to, you know, to be hedged. And
my 2 cents, watch the gamma levels, because this is indiscriminate buying and selling. And right now we've been in a wonderful positive gamma environment. We have literally only need to really you know, drop like 0.6% and we could be into negative gamma, which would obviously kind of unwind some of these last in, first out longs. Then we actually have volatility triggers. If we were to have a 2.5% pullback, keep that level in mind. If we have a surprise 2.5% pullback in SPY, we can actually trigger some very large volatility bouts. So we haven't had it, but it's something to keep in mind. So if you're kind of wondering, why is this getting so aggressive? This is price insensitive sellers that come to market, and they do not care about fundamentals or macro. So keep that in mind. And I wish everyone a great rest of the summer. We'll check in August. Thank you, Craig.
Thanks. Take care. Bye.
Bye.